gentlemen, my name is Lars Schall. I'm a financial journalist from Germany, and on behalf of Matterhorn Asset Management in Zurich, Switzerland, I welcome you to an interview that I will conduct now with Jim Rickards in the US. Hi Jim, are you with us?
Yes, I am, Lars. Nice to talk to you.
Yeah, thank you. Fantastic to have you. Now, you haven't all the time in the world for me, but I have prepared quite some questions, so let's start and see if it's possible to address all of them.
Okay.
Jim, regarding the state of the so-called free markets, would you agree with investment manager Catherine Austin Fitts that Western intelligence agencies have the technological ability to proactively manage the markets in enormous ways, and that this is a dimension of market rigging that too few people pay attention to? She says, if it wasn't for that kind of technology, we could never go to a world where central banks manipulate markets in the way that they do now.
Yeah, I think that's mostly nonsense, Lars. I would say, I think you have to separate technological capabilities on the one hand from actions and intentions on the other. Now let me be clear. I think markets throughout the world are being manipulated, but they're not being manipulated by national security agencies or intelligence agencies or military agencies. They are being manipulated by central banks, and central banks don't need any help from other arms of government because they have their own techniques and their own models and their own channels who are doing so. So I think that if you ask, are the technological capabilities of certain government agencies, and of course we're all familiar with recent revelations about the National Security Agency, but there are many others. If you're asking whether they have extensive technological capabilities, I think it's apparent that they do, but none of that is being used to manipulate markets. But it's not necessary in the sense that, as I say, the Federal Reserve, the Federal Reserve is manipulating U.S. dollar interest rates, but the important thing to bear in mind is that every market in the world somehow keys to or relates to the U.S. dollar, because the dollar is by far the largest market and the predominant reserve currency in the world. So even if you're China or South Africa or a very small emerging market economy, you are affected by the dollar. So when you manipulate the dollar, you manipulate directly or indirectly every market in the world. And that is what I see. I was recently in South Africa, and over a period of 7 or 8 months in 2013, their currency went from 8 to the dollar, which is fairly strong, to almost 11 to the dollar, which was a crash, and then came back to 9 to the dollar, which was a rally, but not back to where it was. And that's enormous volatility. Well, that was not caused by any central bank policy in South Africa. That was caused by the taper talk, the expectation that last winter that tapering would continue, and then the beginning in May, there was some talk that the Fed would taper, then they didn't, then they did. It's that kind of manipulation, change of policy, etc., that's causing volatility around the world. So if you ask me whether markets are being manipulated, I would say yes, but it's not by national security agencies, it's by central banks.
Now that you have mentioned it, do you think the Federal Reserve will have to end the tapering of QE rather sooner than later this year, and maybe even has to expand QE?
Well, it's possible, but here's the Fed's dilemma. The Fed has said that tapering is an economic decision, meaning that they've set 3 criteria to begin the tapering, and this is what they refer to when they started to taper in December. The first is economic growth, the second is the employment situation, the third is inflation. Now, based on the Fed's own criteria, there was a very weak case for tapering in December, meaning that the unemployment rate had come down, but we all know that that was not for good reasons. It was because labor force participation was declining, which is not a good thing for the economy. Growth was much stronger in the third quarter, at least in the United States, but a lot of that was inventory accumulation. It might not be sustainable, and growth appears to be weakening in other parts of the world. And finally, on the inflation front, there was no progress at all. If anything, inflation indices were going down, and then we were getting dangerously close to deflation. So you see the Fed's own criteria. There was not a strong case for tapering in December, but they did. And they've certainly given the market reason to believe that they will continue to taper. be worried about something else. And I think the something else is the state of their own balance sheet. If you could go back in time to 2009 and say to the Fed, you're going to start this QE program, go back to the end of QE1 and the beginning of QE2, and you're going to get to 2014 with a $4 trillion balance sheet and very little to show for it. If you had put that question to them in 2009 and said, will you do this? I think the answer would have been no. In other words, the Fed went down a road, but they never knew how long the road would be, and they never expected to be where they are today. But of course, they are where they are today, and they do have a $4 trillion balance sheet, and they do have very little to show for it. But I think they're at the point where they're beginning to worry about their own solvency and their own balance sheet. The Fed is almost certainly insolvent on a mark-to-market basis. If the Fed were a hedge fund and you mark the assets to market, their capital would be wiped out. So we have an insolvent central bank. That problem is getting worse by long-term asset purchases because the assets they're buying are the most volatile. If you get into a rising interest rate environment, again, that will actually not only wipe out their capital but cause losses at the Fed. This could become a political problem if the Fed needs a bailout. So I think they got to a point they never expected to reach where they're worried about the size of their own balance sheet and their own solvency. And in my view, that was a very powerful motivation to begin tapering. So they sort of grasped at a few straws. There were a couple good economic readings, and that was enough for them to say, okay, boom, let's taper, not because they had accomplished their goals, but because they were worried about destroying the institution itself. The problem is, if in fact the economy is not that strong, in my view it isn't, and they've begun tapering, which they have, they're actually tapering into weakness and may cause a recession. So I think at the March meeting, again, as we move through the spring, you'll probably see them taper at each meeting. I think the expectation is about $10 billion per month. Bearing in mind that even if they do 100% taper, even if they do $10 billion a month for 7 more months and get to zero, they're still going to print $400 billion of money between now and then. I like to say this is like if you're driving a car on ice and you slam on the brakes, the car doesn't stop. It keeps going at least for a while. And even though they've started tapering, they're going to keep printing money at least for a while. So in the best of cases, they'll print $400 billion more before they're done. But it's entirely possible that they've tapered into weakness. They'll have a recession in 2014, and they may have to halt or ultimately increase asset purchases. So I think those things are possible.
Let's say you were the Assistant Secretary of the US Treasury, responsible for economic policy. What would you do to overcome the weaknesses in the US economy? For example, do you think that advances in robotics, fabrication technology and material sciences, along with the development of domestic oil and gas reserves and the resulting drop in energy prices, has the potential to revive some sectors of small and medium-sized businesses in the US? Could it offset some effects of the disastrous policy of offshoring in your country?
Well, what I would say, Lars, is that, and I've said this all along, is that the problems in the U.S. economy are not driven by liquidity, and they're not driven by lack of money. There's plenty of money around. The problem is that people are not spending the money, they're not borrowing the money. We're stuck in a so-called liquidity trap. So when you're in a liquidity trap, providing more liquidity is not the answer. The U.S. has serious structural problems. We're in a depression. We've been in a depression since 2007. We're going to remain in a depression until some structural changes are made. So I think the solution is not more money printing by the Fed or really anything that the Fed can do, but structural changes. These would be, when we say what are structural changes, there are things like tax reform, fiscal reform, less regulation, environmental regulation, improving the Keystone Pipeline, labor laws. There are a lot of things that the Congress and the White House can do to improve the business climate and the productivity of the U.S. economy. So my focus as a policymaker would be, I would want the Fed to stop printing money, to get out of the bond buying business, to normalize their balance sheet, normalize interest rates, and let the market do the heavy lifting. And as far as the market is concerned, you need to create a positive business climate where people are willing to invest and commit capital. To do that, you need some certainty about policy. Right now, if you're a business person and you're being asked to commit, say, $5 billion to a 10-year infrastructure project, and you're responsible for doing the projection, the projected profit or loss on that project, I mean, how on earth are you supposed to know, what your taxes are going to be, what your health care costs are going to be, what your environmental regulation is going to be? You have no idea. I mean, any business has normal business risk. Business people accept the business risk, but what we've done is we've added a whole layer of policy risk on top of it, which is just enough to keep people from making commitments. So I think we need structural changes. We need to reduce what economists call regime uncertainty. We need to be able to say to business people, entrepreneurs, investors that here's the deal. We're going to reduce regulation, reduce taxes, give you a stable environment, make the U.S. an attractive place for investment, not just by American companies, but by companies around the world. Stop fighting the currency wars, embrace a strong dollar. Those are all positive things. Now, the things you mentioned, Lars, are interesting. Kind of robotics, natural oil, natural gas, energy resources. These things are extremely good for the United States, but they do have a couple effects that the Fed is trying to fight that people need to bear in mind. The first one is that they're deflationary. Cheaper energy prices. Now, that's a good thing for the economy. I am not against cheaper energy prices. I'm all in favor of it, but it's important to recognize that is deflationary at a time when the Fed is trying to encourage inflation. The Fed needs inflation to reduce the U.S. debt to GDP ratio so we don't end up like Greece. And so this actually makes their task more difficult. So it's a good thing for the economy, but a bad thing for the Fed because they're trying to inflate away our debts, and deflation doesn't help. As far as robotics, I mean, the history of economic development in the United States is the history of technology, productivity, machinery, or now automation, and high returns to capital that come from that. The key there to help everyday Americans and help workers is to make the labor force more productive, and the way you do that is with education. So I'm not worried about robotics or things displacing workers. What I am concerned about is that the workers don't have the skills they need to team up with that capital and make the economy extremely productive. And that is, again, another one of these structural problems. You're not going to cure the education problem in the United States by printing money. You're going to cure that by structural reforms having to do with teachers' unions, curriculum, and other reforms. And so, there's a lot to do, but almost none of it has to do with central bank policy, and all of it has to do with creating a better business climate and a stronger educational infrastructure in the United States.
Yeah. What has to do with central banks, I guess, is, however, the topic of financial repression, of which we hear quite a lot about these days. First of all, what is this? And secondly, is a primary mechanism of financial repression the suppression of the gold price?
The gold price has something to do with it, but let me just take a second and explain what financial repression is. What the Fed needs to do, and this has been the topic of some very high-profile speeches recently, one about a month ago at Harvard by Larry Summers, but other people have said the same thing. What they actually need are negative real rates. A negative real rate is a situation where the rate of inflation is higher than the interest rate on intermediate-term borrowing. So if I'm going to borrow to buy a house or start a factory or install equipment or start a business, I'm probably more affected by that intermediate-term rate, meaning 5, 7, or 10 years, than I am by the short-term rates. And those rates they've been bouncing around, but they're somewhere between, let's say, 2 and 3%. Now, right now, inflation in the United States is about 1%. So we have positive real rates, meaning the cost of borrowing is significantly higher than inflation, so a borrower incurs very high real costs. Now, what the Fed is trying to engineer is a situation where the opposite is true, where inflation is maybe 3.5%, but they can keep those interest rates at maybe 2.5%. And in that world, you have negative real rates, which is a very powerful inducement to borrow because not only is money free, it's better than free. The bank is paying you to be a borrower because you get to borrow the money and pay the bank back in cheaper dollars. So, but the question is, how do you get there? The policy is clear, but how do you achieve that policy objective? And one thing they're trying to do is print so much money that they sort of raise inflationary expectations. But it's a delicate balancing act. So here's where financial repression comes in. A lot of people say, well, okay, let's say the Fed gets inflation at 3%. It's a very difficult thing to do, but let's say they do it. They manage to get inflation at 3%. Well, what good does it do you if inflation is 3, but the bond market goes to 5? In other words, you still have positive real rates. As long as the bond market rates are running ahead of inflation, you always have positive real rates. You never get to negative real rates, and so you haven't accomplished your purpose. So financial repression is the art of keeping a lid on nominal rates while inflation races ahead so that you can get to negative real rates. So if you get inflation to 3, you have to use policy techniques to keep the 10-year note at 2 or 2.5, or if inflation gets to 4, you need to keep the 10-year note at 3 so that you have negative real rates. Well, how do you do that? Well, one of the ways is quantitative easing. But if the Fed is at the limit of its balance sheet, as we talked about earlier, the other way to do it is to get the banks to buy the bonds. And the U.S. banking system was bailed out in 2008, of course, and a lot of bankers were quite pleased with that result. They're saying, gee, this is great. The government bailed us out, but we get to keep our jobs, we get to keep our bonuses, we get to keep our government-guaranteed liabilities, and make money, and happy days are here again. So the bankers are quite pleased with how they've been able to extract wealth from the U.S. economy. But what they'll discover is that there's a price to pay. It's sort of like a deal with the devil. And the price to pay is that they are now really captive buyers of bonds. If the Fed orders them to buy the bonds, they will do so. And so the Fed will try to create inflation by jawboning and printing money, and then they will keep a lid on interest rates by forcing the banks to buy the bonds. And the combination of the two will hopefully, in the Fed's view, get us to these negative real rates, and then that's supposed to be the inducement to borrow. So that's what financial repression is. It's using either regulation or jawboning or orders or persuasion or direct purchases to keep a lid on nominal rates so that inflation can be higher, and then get to negative real rates. Now, where gold comes into it is there's a danger in what I just described, which is if inflation goes from 1% to 2% to 3%, the Fed would like to keep it there. They would like inflation to be higher, but they don't want it to be too high, because then the game will be very obvious to everyone, and inflationary expectations will race out of control. So it's kind of like playing with a thermostat. If the house is too cold, you dial it up. If the house gets too warm, you dial it down. The Fed would like, when inflation gets to 3%, they would like to keep it there and make sure it doesn't go up to 5, 6, 7, 8, 9%, which or higher, borderline hyperinflation, which is what happened in the 1970s. One way to do that, they have a lot of ways of doing it, including they can reduce asset purchases at some point, or actually do the reverse and drain money from the economy, although it would be highly unusual to be taking money out of the economy if unemployment were still 6% or higher, so that could have its own difficulties. But one of the ways inflationary expectations race out of control that is very visible to the market is the price of gold. The Fed knows that the price of gold is going to go up, and the Fed is not even against the price of gold going up, but they want it to go up gradually. And the word for this is orderly. They don't mind an orderly increase, but what they don't want is a disorderly increase. Disorderly is when gold goes up $50 an ounce one day and $100 an ounce the next day, and then $200 an ounce, and then before you know it, it's going up $1,000 an ounce over the course of 30 days, and everybody's talking about it, and it's racing out of control. The Fed does not want that. So they know that gold will go up. It's been going up forever, at least in dollar terms. But they want it to be orderly. And the way they do that is by using various price suppression techniques, which are quite simple to execute, including physical gold sales, paper gold sales, leasing, unallocated gold. There's a whole bunch of techniques that they use. So they will suppress the price of gold, not to make it a lot lower, but just to make sure it doesn't go up a lot faster to something more like its intrinsic value.
What role will gold play in the future in international trade?
Well, when you say international trade, that's the substance of the economy. That's actually, taking manufacture goods or natural resources or other services and exchanging them among nations. But behind the trading structure is a financial structure. So trade is very important, of course, but the way I usually analyze it is in terms of the international financial system that supports the international trading system. And of course today that's based on the US dollar as the leading reserve currency and the Federal Reserve as the proprietor of the dollar in the US banking system. Now, in the short run, gold has no role to play. Gold is not considered a monetary asset. There's no central bank in the world that will come right out and say that they want a gold standard or that they base their monetary policy on gold. However, the central banks may have no choice. In other words, if you get to, I just described how the Fed wants higher inflation and thinks they can engineer it to exactly the right level, 3%. My view is that they will try that, but they will fail, and in the course of doing so, they'll let the genie out of the bottle, so to speak, and inflation will run away from them to much higher levels. In that world, maybe they can get the genie back in the bottle, as Paul Volcker did in 1980, but maybe not. And if this time we run into another financial panic, something like 2008, except maybe worse, and inflation is running out of control and people are losing confidence in paper money around the world, which I also expect, then central banks may turn to gold, not because they want to, but because they have to as a way to restore confidence. Of course, the result of that will be much, much higher gold prices. When I say higher, I don't mean $1,000 an ounce. I mean going up to $7,000, $8,000, or $9,000 an ounce. That would be where you would have to price gold in order to have an international monetary system that could support trade without causing massive deflation. It's not a guess on my part. That's actually the number you would have to use if you were going to have a system of the type I described. And so I think that for the short run, gold plays no role in the monetary system, but on a shadow basis, it does. This is why China is acquiring so much gold. And in the intermediate to long term, when there's a financial panic and the collapse of confidence in paper money, that central banks and finance ministers will have to return to gold to restore confidence. And of course, at that point, the price will go much higher.
Do you agree with me that one of the big stories of 2013 was the establishment of various physical gold exchanges in Eurasia?
I think it is a very important story, and the reason is that in any commodity, and we happen to be talking about gold, but it's really no different if we were talking about oil or corn or wheat or a lot of other things, you have two things that analysts focus on. One is the stock, and one is the flow. The stock is the total amount of the commodity, so how much gold is there in the world? No one knows for sure, but estimates are around, let's say, 170,000 tons. The flow is the new gold that comes into the market every year from various sources. So mining output, is about 2,300 tons a year, which is quite small relative to the stock, meaning that the gold supply is only increasing about 1% a year or so, and that's one of the attractions of gold. A little more than 1%, but that's one of the attractions of gold, which is that it's scarce and it doesn't go up a lot, unlike money printing. But there's a third element I think you have to put into the mix, which is called the floating supply. The floating supply is the portion of the stock that's actually available for trading. If you want to buy it, where you get it, if you're a seller, who you sell it to, etc. Now, if you're trying to corner a market, going back and looking at history, you don't have to buy the entire supply. You only have to buy the floating supply, because any gold that is in, say, central bank vaults or any kind of vault in private hands that is not available for sale is not part of the floating supply. It just sits there on the sidelines. Now, central banks' gold, I would say, in many respects, is or can be part of the floating supply in some cases because it's available for leasing through the bullion banks in London. But some of the gold is not, or it could change. In other words, a central bank might be leasing its gold one day and then suddenly decide not to lease its gold. So when I see the private vaulting arrangements, and they're in they're in Singapore, Shanghai, Switzerland, they're really popping up. Some of them are long-standing, others are popping up all over the world. When you see that, and we are seeing it, and I recently returned from a visit to Switzerland where I met with refiner, so I was able to talk firsthand to senior people who are actually handling the gold flows around the world. What they're saying is a lot of gold is coming out of the banking system going into private storage. So, a very wealthy individual, someone worth a couple $100 million, might take her gold out of UBS, pardon me, and put it into G4S or via Matterhorn, one of the private non-bank storage facilities around the world. And they're not just in Switzerland; they're in, as we mentioned, Dubai and Singapore and elsewhere. So that gold is kind of when it comes out of the bank vaults and goes into private vaults, it's no longer available for leasing, or at least it's not very easy to do because there's legal arrangements. The banks have had those legal arrangements and the documentation forever, but the private vaults do not. The private vaults are just in the storage business. And so what I see is that while the total gold stock in the world changes very little, the floating supply is collapsing, which means that the amount of physical gold available to support paper trading and market manipulation is getting quite small. So we're almost at the point where it's like balancing, the old trick where you take a pencil and you balance it on its point. It's not going to stay balanced very long. It's going to fall, and we don't know exactly where or when, but you can see the system destabilizing. So I think these private vaulting arrangements are important because they reduce the floating supply available for market manipulation.
One big buyer of physical gold is the People's Bank of China. How much gold do you think has China's central bank by now in its vaults?
Well, the People's Bank of China actually doesn't buy it. The party that buys it is another sovereign wealth fund run by the Chinese Communist government called SAFE, which is the asset management arm of the Chinese government. And so no one knows exactly how much they're buying. The SAFE stands for the State Administration of Foreign Exchange. So they manage China's foreign exchange reserves more so than the central bank. No one knows exactly how much they're buying. We have some export figures from Switzerland. We have some import figures from Hong Kong. We have some mining output figures. It's a little opaque of all the gold that China gets their hands on through imports and mining. How much is going to the government, how much is going to private investment, because individual citizens, pardon me, China certainly have a large appetite for gold. So it's a little bit of guesswork, but I have worked on that, and others have as well. And it seems that the official Chinese gold position is going up at least 1,000 tons a year, approximately, and that's been true since 2010. So you'd have to add probably 3,000 tons to the official number. So if China is officially at about 1,000 tons, which is what they admit to, and you add 3,000 tons on top of that, then that would put their gold reserves at 4,000 tons, which would make them the second largest gold holder in the world after the United States. They'd actually have more than Germany, France, Italy, or the IMF at that point. So they are buying gold. They're doing it through this SAFE, the State Administration of Foreign Exchange. They're using some means that we can detect and covert means, using military and intelligence assets. Putting it all together, they have some number. We don't know exactly what it is, but at this point it's probably north of 4,000 tons a year. Sorry, not 4,000 tons a year, but 4,000 tons in total, acquired at approximately 1,000 tons a year.
Yeah. So this will blow some minds when the Chinese reveal the real official numbers finally.
I think it will make it very difficult for those who disparage gold or those who insist that gold has no role in the international monetary system. Then you could sort of put the question to them, which would be, well, if gold has no role in the monetary system, why did China buy 3,000 tons or 4,000 tons? Are they stupid, or do they know something you don't? Well, the Chinese are not stupid. They've made a number of very smart moves. So my inference would be that they know something the rest of the world doesn't, which is that we're getting closer and closer to a collapse of the international monetary system and a reset that would be, if not a full gold standard, which it could be, but at least with some reference to gold, and that when the time comes to restructure the international monetary system, the people with the biggest seat at the table will be the people with the most gold. And of course, individual investors can be along for that ride.
Last year, you've called the decision of the Deutsche Bundesbank to repatriate some of its gold reserves from abroad as world historical. Why so?
Because it represents a change in thinking, and it is having a big impact on a lot of other countries. Germany's not the only one who has repatriated their gold. Of course, Venezuela did that a few years ago. Azerbaijan has done it, a much smaller player, but they've done it. Interestingly, Russia and China don't have to repatriate their gold because their gold is already in their countries. They don't leave their gold, or at least not very much of it at all, at the Federal Reserve Bank of New York or the Bank of England. But Germany is the second largest gold holder in the world after the United States. And so their decision obviously will have a very big impact, and it just changes the way people think. This is now a political issue in the Netherlands. It's a political issue in Switzerland. There are other countries who are thinking about it. Italy, of course, has made it clear that a lot of their gold is already in Italy. But the other thing it does is it starts to unwind the price suppression mechanism, because the price suppression mechanism is done largely through central bank gold leasing. In other words, the central bank leases gold operating through the BIS in Basel, Switzerland, to a commercial bank. The commercial bank can then sell 10 or 20 times as much gold on a so-called unallocated basis, where they put some gold in storage and then they sell more gold than they actually have. If you read the fine print in the contract, it says that you don't have specific bars, the specific numbers. You just own some gold, but the expectation is that all the holders of those contracts will not show up on the same day and ask for their gold. Very similar to the paper money banking system, where banks create far more in assets by making loans and crediting deposits than they actually have in capital. So we have a fractional reserve paper money system, and we have a fractional reserve gold system operating through the bullion banks. Now, however, it does require some physical gold, not a lot, maybe less than 10%, but it requires some. And if you begin to withdraw gold from the central bank depositories in New York and London and move it to places like Frankfurt that don't have these legal arrangements in place, then it makes it harder and harder to run the price suppression mechanism using paper gold based on a small amount of physical gold. So it by itself, it doesn't cause the house of cards to collapse, but it is you're sort of removing a card, if you will, and I think this structure gets a little more unstable by the day. Lars, probably have to jump at this point, but I really have very much enjoyed talking to you.
Okay, thank you very much for this conversation.
Thank you, Lars. Bye-bye.
Okay, bye.